Today, we will talk about Forex trading tips for beginners. What is Forex? Forex, also FX, is an abbreviation for foreign exchange. Foreign exchange takes place when one country's currency is exchanged for another country's currency. Forex is the largest financial market in the world, trading some $5 trillion daily. Most trading is done in the spot cash market, conducted primarily by banks. Major banks around the world constantly exchange currencies for their customers for tourism, trade, and for their own accounts to speculate on the daily changing values of the currencies. The Forex exchange rate. The exchange rate is the price paid for one currency in exchange for another. It is this exchange that drives the Forex market. The rates quoted for each currency float up and down depending on supply and demand, as well as other economic or geopolitical events, thus providing the opportunity to speculate on the movement of one currency against the other. Anyone who was alive through the 90s will remember the era of get-rich-quick schemes. One after the next, they poured in over the radio, through email chains, and especially infomercials. The yuppie generation was in, and they wanted to make a lot of money really fast, and they were willing to take a lot of risks to do it. Remembering this era is why we don't like to think of trading as a get-rich-quick scheme or a surefire monthly income. That said, trading can undoubtedly bring in extra money at a very low risk since you don't need a large amount of capital to start. You can check out how brokers like Owanda function at Forex trading, or you can go it alone and learn on the fly yourself. Let's take a look at how one makes some extra money with Forex trading. Forex Market Basics. Most international Forex trades and payments are transacted using the US dollar, British pound, Japanese yen, and the euro. Other popular trading pairs include the Australian dollar, Swiss franc, Canadian dollar, and New Zealand dollar. The Forex market operates 24 hours a day, opening at 5 p.m. each Sunday EST and closing at 4 p.m. on Fridays EST. Hence, most Forex brokers offer 24-hour Forex trading to day traders worldwide. When dealing with foreign exchange, the transactions are always quoted in pairs. For example, when exchanging euros, the European Union currency, against US dollars, the transaction would be quoted as EUR/USD. If we were exchanging dollars for Japanese yen, the quote would be quoted as USD/JPY. The benefits of the Forex market for active traders are usually useless or even harmful for passive investors. Low trading costs mean very little if you do not trade very much. Using high leverage without a stop-loss order can lead to large losses. On the other hand, using stop-loss orders essentially turns an investor into an active trader. Forex market participants. Besides the banks, which usually trade for large customers, large international corporations have trading desks that trade Forex as a means of hedging their costs of exports and/or imports of goods and services. Often this type of trading can also be done in the futures market. In addition, there are many brokerages that offer Forex trading for individual traders. Forex trading is largely speculative, and because the Forex market is so liquid, traders can buy and sell currencies almost instantaneously, and therefore manage their trades efficiently. Nearly 90% of all Forex trading is speculative trading. Trading in Forex is done using both technical and fundamental analysis. Breaking down a Forex quote. Here is how a quote would be shown. EUR/USD 1.17064. Thus, 1 euro can be exchanged for $1 and 17,064 US dollars. The inverse would be $1 exchanged for 0.85422 euros. For example, if today we sell $1,000 against the euro for 85,422 cents per dollar, and later we buy back the $1,000 for 0.81422 cents per dollar, we would gain 4 cents or $400 on the trade, less any commission charges. If the above trade was for $100,000 against the euro, the profit would be $4,000 for that same trade. Danger lurks behind Forex leverage. Because the Forex market is so liquid, it is also highly leveraged. This means that brokers and banks are prepared to lend up to 100 times the amount of cash funds you have on deposit to trade with. However, as the leverage increases, so does the risk associated with any trade. The reason for the increase in risk is due to the fact of being leveraged means using the bank's or broker's money, and the margin for error becomes much smaller. An important thing to remember is that in Forex trading, as with most endeavors, you'll need a solid grounding in the fundamentals of how everything works before you can expect to start making any money at all. A great way to find out what you're getting into is to watch some online tutorials, or even take a course at the basics. Another thing to do from the outset is to remain realistic and manage your expectations of the process. Nothing comes without some hard work and understanding of the processes within the industry. The difference between a trader who does well and a trader who fails spectacularly is pretty much the same as what separates successes and failures in any field. The ones who make it and make a little money in the process are the ones who try every strategy that they know of to achieve success. Another good idea to get you firmly set up at the beginning of your forays into trading is to open a demo account instead of jumping into things too quickly with a real one. This account allows you to operate in real-world situations without actually risking anything. It will enable you to practice how you'll react when the stress comes rolling in, and you have to make quick decisions. This is the time to make your mistakes and learn from them. With literally nothing to lose, all a demo account can do is make you a better trader. You'll be able to watch how the market moves, learn all the jargon that previously sounded like Greek to you, test out any theories you've developed, practice trading different currency pairs, and try out other platforms. Final thoughts. As with all trading, especially Forex trading, it is important to understand the economics behind currency valuation and the role that each country's economic and geopolitical factors play, as well as the role that each country's central bank plays in managing their country's currency. Although Forex has a reputation as risky, it is actually an ideal place to get started with active trading. Currencies are generally less volatile than stocks as long as you don't use leverage. The low returns for passive investment in the Forex market also make it much harder to confuse a bull market with being a financial genius. If you can make money in the Forex market, you can make it anywhere. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.